Hello students, today I would like to welcome you all to this video. In this video, I'm going to make statement of financial position for you guys. The old name of this is balance sheet. So the question that I've selected is the same that I've sold. The income statement for you guys is Shobi, is a sole trader. So it's in October-November 2018, variant 2, question number 5. So as in the previous video, I have made the income statement of this business, and we ended up with the profit of 21,850. So I'm going to solve this question's statement of financial position for you guys. So let's start. So we have this statement of financial position format. So I'm going to make this with the 3 columns. Usually in the exam they may give you 3 columns or 2 columns format, but for the statement of financial position it's better that you use this 3 columns, because for the non-current asset section, that's the first section that we need to make in SOFP, statement of financial position. So in this section we need 3 columns. So the first column in this section, I always tell my student that this will represent the cost value of non-current assets, and the second column will represent the accumulated depreciation, means the total depreciation, or we can say that the provision for depreciation account balance, and the last column will represent the net book value, which means that the cost minus accumulated depreciation will give us the net book value. So let's start solving this with the non-current asset. So we need to come back to the question, and we need to see that how many non-current assets we do have. We have a 10 years leasehold premises, we have a motor vehicle, and we have a fixture and fitting. So let's start with the leasehold premises. So it says that it has a cost of 120,000. So write down here leasehold premises, and that is 120,000. The cost obviously that will come up here. So as we already made the income statement, so we already calculated the depreciation of 12,000 for this leasehold premises. If the students, they will not have to make the income statement, so they have to calculate the depreciation similarly that we have done in the income statement section. So the formula, or the way to calculate the depreciation will be given to us in the question as it was in here. Let me show you again. So in the depreciation is charged on all non-current assets owned at the end of the year as follows: an appropriate amount of 10 years leasehold premises. So 10 years leasehold premises means we need to divide the cost by 10. So the cost was 120,000, so divided by 10, so 12,000 was the depreciation that we have calculated here in income statement. So now in SOFP, which amount of depreciation we supposed to record here in this second column? So that will be the first of all, we have an opening balance of depreciation that will be the given in the question. So let me show you. So we have it here. So that's the cost, and that's the provision for depreciation balances, opening balances, and it shows us that it has a previous balance of depreciation of 72,000 against this 10 years leasehold premises. So we calculated the current year depreciation is 12,000, so we add this up with this balance. So 12,000 plus 72,000, so that will give us the 84,000 figure of the number. So here in this column, the second column, we will write down the total depreciation, means the accumulated depreciation balance, and that will be 84,000. Now in the next column, the net book value, we need to deduct this 84,000 from 120,000, so that will give us the net book value figure. So 120,000 less 84,000 will give us 36,000. So that's how we need to present our non-current assets. So leasehold premises is done. So the next non-current asset that we had in the question was motor vehicle, and it was 40,000, and there was another adjustment of 12,000, so we need to add this up. So now we had a motor vehicle of 52,000. So I will write down this with the cost here. That will be motor vehicles, and the cost will be 52,000. Similarly, if we are going to make if we have an income statement, so what do we need to do? We need to see how much depreciation we already charged, and that was 10,000 against motor vehicle, and then we have to add this up with the current year depreciation, 10,500. So 10,500 from here and 10,000 from here, this will give us the total figure of 20,500. So 10,000 plus 10,500, so 20,500. So again we need to deduct this from the cost value. So 52,000 less 20,500 will give me the balance of 31,500. So 31,500 will be the second asset's net book value. Now the next third asset that we have in the question, it says the fixture and fittings. So fixture and fitting had a cost of 19,000, so I will write it down, fixture and fittings. And it has 19,000 cost, and we have the opening balance of depreciation is 7,600. So let me write it down here on the calculator, 7,600. And we calculated the depreciation in the income statement earlier, and that was 1,900. So it's here. So I will add this up, 7,600 plus 1,900, which gives me the total of 9,500. So I will write it down, this figure here, 9,500. So I will deduct this from the cost value. So 19,000 less 9,500 will give me the balance of 9,500. So it's exactly the half of the amount. So the next thing that we need to do is to balance the columns. So we need to balance all three of the columns. Cost column we will write down a line underneath, so that will be a double line, means we are not going to use this balance anymore in our further calculation, but we are not going to write any line under this total because we are going to use this balance. So this will give us the total of cost 120,000 plus 52,000 plus 19,000, which gives us the total of 191,000. So I will write it down, 191,000. Now the provision for depreciation, or the depreciation column, total 84,000 plus 20,500 plus 9,500, which gives me a total of 114,000. So I will write it down, this 414,000. So there are two ways: either you have to deduct this total depreciation column from the cost column to get the answer, so which gives me a 77,000. So we can also verify by adding this column, the last column, so that will be the 36,000 plus 31,500 and 9,500, which again give me a total of 77,000. So means the total is double checked. So this is the non-current asset section. Now the next section that we need to make in statement of financial position or balance sheet is the current asset section. So current asset section has a sequence, so we need to follow this sequence in the exam. So it starts with the closing inventory balance, and the next thing will be the trade receivables, and we need to deduct from this trade receivables the provision for doubtful debts balance. So less provision for doubtful debts. So this will be the third thing, and if there is any other receivables that we need to mention here. So and then there will be a cash or bank balance if we have any. So let's start with the closing inventory. The closing inventory is always mentioned here in the adjustment section. That will be the first adjustment that we have. So inventory was valued at 19,500. So you guys can have this value from the income statement as well. So as you can see, we had closing inventory in the cost of sales section, 19,500. So same amount of value, I will write it down here. So I will write it down here in the second column, 19,500. Now the trade receivable figure that is given in the question we have here is the second last number, 23,250, and there was an adjustment of irrecoverable debts, so we have to deduct this. So 23,250 less, so 23,250 less 750, it gives me the figure, yes, it was 750, so it gives me the figure of 22,500. so I will write it down, this 22,500 here. So I would like the students to mention this 23,250 less 750 into the brackets, so that will easier for the examiner to understand how you got this number. So now we need to deduct this provision for doubtful debts balance, as says in the question that we need to calculate the provision by 4%. So if you guys can read the last adjustment that we had, so it says that trade receivable or 750 are irrecoverable and provision for doubtful debts is to be maintained at 4%. So now here we don't need to calculate the increase in provision or decrease in provision. We just need to multiply this number by 4%. So like this, 22,500 into 4%. So into 4 divided by 100, which gives me a number of 900. So the 900 will be the provision figure that need to be deducted. So once we deducted this from 22,500, it gives me 21,600. So I will write down this 21,600. As you guys can see that I have used this third column here for this calculation. So if there is any calculation before the value comes here, so we need to do the calculations here, and then the final figure will comes up here, and this column's final figure will goes here. So that's the current asset section, and that's the adjustment section in the current assets. So if there is any adjustment that we're supposed to do in our current assets. So we are done with this trade receivable and provision for doubtful debts. Now the next thing is other receivables. For the other receivables, we need to remember that in the current asset section we have to write it down the prepaid expenses, because that's our expenses, and accrual income if there is any. So let's find out how we can find out this the provision prepaid expenses. So we need to come to this adjustment section of the question. So we'll see, and if we have any prepaid, so it says here in the rent payable include a payment of 9,000. That's for 6 months ending 30th November. So our year end is 30th of September, as you can see here. So 30th of September and October and November, 2 months we paid in advance. So we need to calculate this, as we already done here. If you guys can see, I have done in the previous question, so it was adjusted with the rent payable. So because prepayments are deducted, from the balances in the income statement, so the other way to find out, if you guys are making the income statement earlier and then the balance sheet SOFP, so from here, from the income statement section, you can find out the negatives, that will be the prepaid. So the negative here, we do not have any other negative, but we do have rent receivable 150 accrual. That means it's over accrual. We can reconcile or reconfirm this by looking here in the adjustment section. So it says rent receivable of 150 was outstanding. So we have to write it down here, the prepaid expenses, and that was rent payable 1, and that was 3,000, and accrual income, and this was, if you can see here, the rent receivable outstanding. So we'll write down rent receivable. This receivable doesn't mean it's trade receivable. So rent receivable is representing our income. So income that's supposed to receive. So 150 was outstanding. So we'll write down only 150 here. So that will be the other receivables. And now we need to find out if we have a bank positive balance or a negative balance. As we have here, the bank debit balance means a positive balance. It will comes into our current asset section. If we do have a credit balance or an overdraft balance, so that will goes to the current liabilities section. So there was an adjustment of 12,000, so we'll deduct this 12,000 from this balance. This 12,000 was for a motor vehicle adjustment that we purchased by check, and we did not make any adjustment into the record. So we'll deduct this, and after deducting this we will end up with $1,350 because it was 13. So let me show you the bank. So it was 13,350 earlier. So we'll deduct this 12,000 adjustment from here. So we'll end up with $1,350. So this is the current asset section. We need to total this up and we need to transfer this total here. So let me make a total. So it's as the first figure is 19,500, so then 21,600, then 3,000, then 150, then 1350. So the total of this is 45,600. So we'll write it down here, 45,600. This represent our current asset total. So now we need to add these two numbers, that was our non-current asset total and this is our current asset total, which gives us the total of our assets. So this again is going to be represented with the two lines. So 45,600 plus 77,000, so 122,600. So 122,600 will gives me the total assets. Okay, so after this section, so we need to make the non-current liabilities and liabilities section. In some writers or some formats, they may mention the equity section before, means the capital section before the liabilities section. I usually tell my student why follow this structure, means the current liabilities or non-current liabilities section first, because in incomplete records where we are going to make statement of affairs, so we do this the same format, like assets and then liabilities to get the capital figure. So that will be easier for you to memorize, that assets then liabilities and the same format structure will help us on that section as well. So that's why I follow this one. So let's see, we have a non-current liabilities. So non-current, I missed the current. So non-current liabilities, so long-term liabilities if we have any. So let's see in the question. So we have here a bank loan payable in 2020, as we are going to make this in 2018, so means it's more than 1 year longer period, so we are going to write it down as our non-current liability. So that will be 50,000. So over here, so write down it was a 6% loan, so write down 6% loan, and that was 50,000 because there was only one non-current liability, so I will write it down in the final figure column straight away, so no adjustment is going to be made. So then there will be a current liabilities section. So the current liabilities section, so you guys can always start from the trade payables, and then if we have as we have used the other receivable section here, so there will be other payable section, other payables, which shows us the accrual expenses and prepaid income. I don't think that we do not have any the prepaid income in the question. So let's start with the trade payables. So we have trade payables here on top of the trade receivable, so 26, so we have $23,050. so I'll write it down, $23,050 here. So then the other payables means the accrual. So here we have some accruals, 26,000 against the general expense, 2600 sorry, against the general expenses, and we do have 1700 against the salaries. So 2600 and 1700, or we can come back to the income statement, as we know that the accruals we added up in the income statement. So we see that there is an addition here and there is an addition here. So these two additions will be over the accrual expenses. So the first accrual expenses that we had was against the general expenses, 2600. So we'll write it down here, general expenses 2600, and the next one we had against the salaries 1700. So we'll write it down, salary here and 1700 here. So that will be the current liabilities, as we do not have any income prepared, so we're not going to write it down here. If we do have any other income prepared, so we'll mention here in the current liabilities. So we'll add this. So the current assets will be 23,050 plus 2600 plus 1700, which gives us total of 27,350. So 27,350. By adding these two, the non-current liabilities and the current liabilities will gives us the total of the total liabilities. So that will be 77,350. So let me mention here. So total liabilities. The next section is the last section that we need to make, is the equity section, which means the capital section. So it starts from the capital. That will be the opening capital that we have in the question, and then we have to add the profit for the year into this because that belongs to the owner. So profit for the year, and we need to deduct drawings from this one, and that's the balance. That's the only adjustment that will come up here. So the capital we have in the question, let me show you, it's on adjustment number 16. So it says $40,000. So I'll write it down here, 40,000, and we'll add the profit for the year as we already calculated, 21,850. So 21,850 will be added up here, and the drawings. So we'll come back to the question again to find out drawings. Yes, here it is. So there was an adjustment of drawings of goods, so we need to add this up. So let me show you the transaction here. So Shobi has taken 4,700 goods for own use. So these are goods, drawings of goods. So we need to add up here. So 11,900 plus 4,700. So 11,900 plus 4,700, which gives the total of, let me check, 11,900 plus 4,700, which gives the total of 16,600. So we need to deduct this one. Yes, so let's make the total of this equity section. So we have 40,000 plus 21,850, and then we need to deduct this 16,600. It gives me the balance of 45,250. So I'll write it down here, 45,250. Now we need to add this total liabilities and the equity section total. This is our closing capital balance. So opening balance plus profit less drawings, which gives us the closing capital balance. So total liabilities and capital, it should be equals to our total assets figure. So let's have a look. So 45,250 plus 77,350, this gives me the same number, 122,600, which means our question is absolutely correct that we have done here. So that will represents the total of liabilities and capital. It shows the similar it shows that the accounting equation is going to be fulfilled as the assets are always equal to the liabilities plus capital. So that's how we need to make the balance sheet, or the new name of this one is statement of financial position. So that's the format. It starts from the non-current assets, first column cost, then total depreciation, and then net book value. So current assets, we always have to start from the closing inventory, then receivables, provision, then other receivables, we need to write it down, prepaid expenses and accrual income. In the other receivable section, we do have a bank if we have a positive balance of bank. If we do have a negative balance of bank or an overdraft balance of bank, that will be mentioned here, in the current liabilities section. So after making the total of total assets, so we'll write down non-current liabilities, bank loan, and the current liabilities, trade payables, other payables. If there is an interest accrual, so obviously that will also come up here because interest is over expense. So interest on loan, if there is any interest on loan accrual, means we have not paid yet the interest, so we'll write it down here as well. So the total liabilities, obviously by adding non-current and current liabilities, and then we have the equity section in which we will write down capital plus profit for the year less drawings, and which must be equal with the asset, non-current asset or current assets, total assets, and this non-liabilities plus equity. The balance should be equal. That will ensure that our income statement as well as our balance sheet or the statement of financial position is correct. So if there is any question or any comments, you can write it down. So thank you very much.